Hello and welcome to Options Guide TV. My name is Brian Overby, author of the Options Playbook, and your host for the next, let's call it 20 minutes here on Options Guide TV. Markets are struggling. They're struggling with the CapEx scenario, and it's a great example when SpaceX comes out and does an IPO and then decides that they're also going to go out and raise additional monies above and beyond the billions that were brought in via the IPO. And so, because of that, SpaceX is getting beat up. We're seeing Google, who also came out and is using, I don't know, creative means to try to generate capital. It's just a grab for cash, and the markets are punishing the firms that are looking to do that. But I think as far as the race is concerned, the firms have decided that if you don't get the CapEx now and you can't spend it, you're going to be left behind. And that's what Alphabet, that's what even SpaceX are doing right now. Now, the companies that are benefactors in this, well, first of all, you see it in the financial marketplaces. You see a lot of financials coming back and actually doing fairly well. And that is actually the one sector. Why? Because they do deals, because they are the generators of this capital. And we've seen Goldman Sachs do well. We saw JP Morgan do well recently, two of the biggest deal makers that are out there. And then that is just an area, I think, almost an area of safety at this point in time, because that sector was getting beat up. Well, not doing well. It was underperforming the market for a long time. And now maybe the XLF, which is the ETF that tracks the financials, is where you want to be at this point in time. Berkshire Hathaway, that's also an interesting stock. It hasn't done well since Warren Buffett has left, but they have capital and they have means. And if you're worried about CapEx spend, that is one company you don't have to worry about it with. So the other companies that are benefactors, like Caterpillar, anything in the construction space, those the receivers of that CapEx spend, those companies are doing well too. So we have Micron Technology. It's one stock, one bright spot that is in the space, in the CapEx space, that semiconductor space, the whole gamut, that still continues to be strong. We get pullbacks, but every pullback gets bought. They're going to be announcing earnings at on this Wednesday. So I'm going to put a trade on, and we're going to go extremely wide. We got a $1,182 stock. It's up 4.29% today, and I'm a little sad that the market, well, we had to wait till 11 o'clock before we kicked off our show, but looking to get long Micron Technology, and we're going to do our open wing butterfly. And then we're going to come back, and I'm going to let you know that if you are a follower of the show, on Wednesday, before the earnings event, I'm going to actually look at a skip strike butterfly, something on the upside that will generate some income that's an alternative to a short credit spread. But heading into that earnings, I don't want to put that trade on right now. There's just too much time on a stock like Micron that could just pop 4% for for just because. So the stock can be up 4%, down 4% based off of all of this news cycle that's going on in that space. So let's do a long. We're going to look at an open wing butterfly with calls in the short-term expiration, the June 26th expiration, which is 4 days away. The stock is right now trading at 1,885. I'm going to go up to the 1,200. In that instance, we're actually buying, we're looking at a 50 delta here. The one standard deviation move, just so that we have some reference, let's call it 160. So you're talking about 160 some points. As a matter of fact, let's go up a little bit more because of the 160. And we're going to look at something that has around a 40 delta. Here's the 3,052. Let's go 1,250. So well within the expected move. And we're going to be buying this option contract. We're going to go up 50 points. Need the screen to move a little bit here. And we're going to go up 50 points, and we're going to sell 2 of the 1,300 strike call options. And then we're going to go about, we'll either go, we could go 25. That would be right in the middle. Let's see if we go 25. Let's see exactly where we end up at. 875 on a 50-point wide trade. Yeah, that's beautiful, right? And I'm saying acting that way because it could have been a lot more expensive. You have 50 points of upside and you're paying $9 for it. It's high volatility, high underlying price, just solid mechanics as far as Micron is concerned across the board. 1,250. Yep, I like it. The one standard, if we look at the delta of the 1328, there's a 30% chance of it reaching that. If it goes above and beyond that, we can make it 20. Let me see. So we got 50 points minus 9. We can make $41. 25 minus 9 is 16. We can make $16 above 1325. So let's go and take a peek at that. Send it to the what if calculator. So we came in that says $1,552 based off of $8.87 limit price. I'm going to put it in at 9. I would work it at 9. It's 925, but we just saw it jump quite a bit. Did Micron go up again? Seems like whenever we're doing the show, it decides to pop a little bit, and it did. It always seems to go against us a little bit. Well, right when we start the show, so now it's up $53 at this point. Man, I really like that $9 price. I'm gonna 923. I would work it at 9. There's no rush on this because the earnings isn't until Wednesday. All right, but I got to make it more accurate for the show. So we'll say 930. 925 is here, and that'll be our price. But so the way the open wing butterfly works, to explain it again, as we usually do, we cover all the details of the trade, is a standard butterfly. If you're going 50 points wide, you would go buy the 1,250, sell the 1,300, buy the 1,350. They would be the same with between the first call and the middle strike, and the middle strike and the last call would be the equidistance apart. It would be a lot cheaper situation, but anywhere above the 1350 level, you could lose on the trade. But in this instance, you have such a wide range, but the stock is saying that it can happen. That's the issue, is you got to trust that the reason why this vol is so high and that you have an expected move of 160 points is because it can do it. That the marketplace, that's the over-under on what the marketplace thinks can happen by Friday. 160-point move is feasible. So I like this for $9. And why are we able to do this trade? It's because it's $1,000 stock. It's because we have earnings. It's because implied volatility is really high. And that's the reason why we can get such a wide, long call spread on our open wing butterfly and pay for it with the short call spread. This is a real solid risk reward in Micron. And it has everything to do, as far as pricing is concerned, with volatility is why butterflies are cheap. And that's why we like to look at them around earnings. But also the fact that you have a very expensive underlying stock. And if you think of options as insurance products, is it cost you more to insure a Bentley or a Ford Taurus, right? The Bentley costs you more. And in this instance, based off of the price, Micron is a Bentley. And as a matter of fact, from what it's done with the stock over the last year, you could see why it would be considered a Bentley. So in this instance, that's the trade that we're going to do. So let's get this down to the trading floor. So let's go back to the trading page and let me set this up, and we'll give you a read back here before we send it down to the floor. So Micron is trading at $1,192.47. It's up $58.48 on the day, or 5%. It's actually up since we started the show. We're going to look at the June 26th expiration, which is only 4 days away. On Wednesday, the company is going to be announcing earnings after the close. We're going to look at a open wing butterfly with calls. So we're going to be buying the 1,250 strike call in that expiration, selling 2 of the 1,300 strike calls, and then stopping short on our short spread to complete our butterfly. And we're going to buy the 1,325 strike call. Right now, the midpoint is $9.35. We're going to send this down to the trading floor at $9.30. That means for every 1 by 2 by 1 open wing butterfly, it will cost us $930 plus any fees or commissions that you might have to put the trade on. And that will be our max risk on the trade. All right, let's send that to the trading floor. Boom goes the dynamite. Order has been sent. All right, so we see these are the strikes that we have the opening order that we're working in this instance. And yeah, on Wednesday, we will look at a skip strike. We'll be able to get gosh, 190 points out of the money and still bring in a net credit on that position. Just a real interesting underlying to be trading in around earnings. I don't mind. I'm kind of curious what the July 10th is at. The vol 104 is the historical vol. 125 is the actual vol. Let's look at the July expiration. That's going to be the official paper trade, but let's check out July. I'm kind of curious if we did something similar. We did the 1250, 1300, 1325. Let's see if we got those same strikes in this expiration. 1250. This might be significantly cheaper. Added too many legs. 1 second. Let me clear them all out. 1250, 1300, 1325. We're just getting the same price. It's the July 2nd expiration. Yeah, that's a couple of pennies more. Let's go really wide. Let's take this. Vol skew is good for this trade. I mean, if we look at, it's the same scenario that we had in SpaceX. SpaceX, you're double up to catch up. We did a lot of trades on SpaceX around hedging, and if we put the hedges on, well, you were better off if you just didn't buy SpaceX. So let's say that if you didn't participate in the chase, you were doing better. But if you did, we did a fundamental Friday and we did a collar trade, which was very helpful. You can obviously just close out the hedge and stay long SpaceX. But the reason why these trades were interesting in SpaceX, there's the same type of thing with Micron, in that if you look at the money vol, we're at 127 here. And as we go up, vol is actually getting higher on the out of the money calls. And these are real option contracts, right? So you're looking at let's go 1400, and you're paying 128 vol for that contract. Whereas if we look at the money vol, we're paying 126. So we're getting a solid skew to the upside on even way out of the money calls. 129 on the 1420s. So this is not a bad scenario. And with SpaceX, we actually saw the out of the money calls trade at higher volatility than the out of the money puts. And it just showed you that the demand for the calls was greater than the puts. And that was prior to the downturn. Now that the downturn happened, once again, it was just a very interesting pricing scenario, because the stock went down and volatility came in. after the run up, because I think the way the market started, that people were assuming that it was going to 400, that it was going to the moon instantly, and that it wasn't going to stop. And then all of a sudden they decided that they're going to raise some more capital, and because of that, the stock has tanked. It's been hurting. All right, so if we looked at, I don't like the July 10th one. It's too much time. You're going to get the move, and you're going to have just too much time premium left in the options. But I'm just curious where it was at. So that's our official paper trade. I like that one the best. Buying the 1250, selling the 1300, buying the 1325. Net debit, $9.30. I'll make sure that this gets executed before we leave. I would work that trade, and I don't mind putting this trade on heading into earnings. And earnings is Wednesday after the close, but on Wednesday we'll come back and we'll actually look at a skip strike butterfly, because we'll get so far out of the money on Micron that I think it will make that trade interesting overall. Now, if you have any questions or comments, I do see a comment out here. Good morning, Kurt. Good morning. SpaceX. Let's go look at SpaceX. I don't know how. I mean, if you have small children in the room, you might want to close their eyes, because SpaceX is down another 10%. We're getting pretty close to that IPO first print at this point in time. Stock ran up to 225. I feel sorry for the one person that bought it right at 225, right? There were a few of them that were out there. Now the stock is down to 168.23. We looked at, and if you have the scenario, I actually tweeted it out in my x.com. I made an image because I was so surprised at, and it wasn't a video, it was just an image of front spread, that if you had 100 shares of SpaceX, I called it a covered call on steroids. And I think that trade is still very valid. And if I had SpaceX, and let's say I bought it at 200, I might do that trade. Don't let me I don't want the cheese anymore. Just let me out of the trap. You can go out about, maybe 25 days. Maybe you got to go 25 days, but let's look at 18 days, and we're going to go quite a bit wide. And I'm going to say, if you have 100 shares of SpaceX, I already have about 4 of these trades inside the paper trading portfolio. So I'm not going to send this one to the trading floor. But I think because SpaceX was down on Friday, and now it's down a huge chunk again today, I think I think I deserve, or I think I need to talk about how we can hedge SpaceX. And I would do one of these 2 trades. If you think that it's going to bounce, and that it's eventually going to come back, and that they're going to finally get over the CapEx spend thing, which the market has done that about 5 times so far this year, where it gets mad about CapEx, and then they say, "Oh, okay, you're okay if you're spending billions of dollars on what's to come," I guess. 1880. We're going to buy this one. And we got to go 90. That's 15 points. That brings us in a small credit. I think we do 12 and a half. 18 days, 285. Yeah, that's not horrible. Okay, so in this instance, this would mean that if I put this on for 167.50, I have to be prepared to sell it, because there's probably a lot of people that own it right between 180 and 200. I don't know when it started running up to the 225, if FOMO kicked in. That would be one of the reasons why you'd be buying in this range. But this was the move after a day, and then the next day, a lot of people started trading it somewhere in this range. All right, so if you think the market can come back, and you're willing to give up your shares at 192.50, now you can try to address that. You can try to roll it. You could try to do something with it. But this allows you to be on margin from 180 to 192.50. And now margin is a strong word there, but ideally you're going to be long one extra call. So it would be kind of acting like 200 shares of stock between 185 and 192 without paying for that extra shares of stock. We're going to actually take the price of the two call options, the premium that we're bringing in, and we're going to use it to buy an extra call. So if I just sold this outright, I would receive about $6. Now I'm receiving $2.85, $285, about half of that. But I'm, in theory, going to own stock on margin. I'm going to have an extra call option from 180 to 192.50. So I can make an additional $12.50 in this range. And this only works when you have high volatility in the underlying. So usually when the stock goes down, SpaceX has just had high volatility, and you see the IV right now is at around 90 in these option contracts. We could go a little bit further. If we go out to the 25, we might even be able to go a little bit wider and get a decent credit. But I'm going to send this to the what if calculator, and I'll talk about you have, and I got to keep emphasizing this, you have to own 100 shares of stock, or this is considered a naked call option. You would be long one, short two, long one, short two, and that second option would mean unlimited risk to the upside, and I definitely don't want that. So if you have 100 shares of stock, and I'm going to add the equity, now it looks like a covered call, but look at this. Gets a little steep between here, right? And that's what I mean by owning the stock on margin. It comes between 185 and that strike 192.50. It's like owning 200 shares of stock instead of owning 100 shares at expiration. If we say it at expiration, then it is accurate. And then from that on up, we have to give up our 100 shares, and we still have our call option. We'd have to trade out of it, but you're wide enough here too that you can actually just sell the call if you would like. You got to make sure that, well, the way I always like to look at this trade, and I've done this many times in my own account, is if I had 100 shares of stock, and the one that we did on Options Guide TV that worked out really well was an NVIDIA after the DeepSeek moment, but I have more than 100 shares there. So let's say you had 200 shares. So you do this trade on 100 of your 200 shares. Then you can trade out of the call because you can let the short option contracts just expire because you only did it on one of your 100 shares of stock. That makes sense. I don't know if I explained that well. So I do a 1/2 SpaceX front spread, but I have 200 shares. So at risk, because I have this extra call option, is only really going to be 100 shares. So it is a way to play that extra call, and you can close it out then, and then you can just let the calls be covered by the actual 200 shares. Yeah, I like that scenario. That's a little bit better. Now, if we go out a little further in SpaceX, and we go out to the 25-day scenario, and here we were looking at 180, 190, 250. We might be able to go a little bit wider. Okay, so let's clear this out. And let's look at 180. Very expensive. Yeah, we could go to 195, even 197. You could at least go to 195 and still get a decent net credit. 197, you're close. 200, you're even close. Yeah, you could go, so you could go 20 points. Let's try this just because we're going to do something. This is just obviously something different. So that's a 140 net credit. And now you have 20 points instead of 12.5. You got to add another week of days in July 17th, and you get a little bit smaller credit. So it's a little bit less of a hedge to the downside. But this is also an interesting trade. And I like that it's nice round numbers. 180, 200, buy one, sell two. If you have 100 shares of stock, you're covered in this situation. You got to be able to do long call spreads. You got to be approved for spread trading inside your account. But this is an interesting alternative if you bought the SpaceX and now you have an issue. double up to catch up. All right. Then lastly, the trade that we put on in SpaceX, and I'll bring this last one up and we'll call it a day. If you have any questions, please do put them in the chat box. I'm happy to address anything that we have. We're going to come back on Micron. We're going to look at another trade on Wednesday. But if you had 100 shares, a collar is also an interesting trade. Like I said, because of the volatility skew, you got to stop the bleeding close here. So if you do 160, that's 7 points. Yeah, that's not bad. So you're looking at 1140, and then we go up here and we see how high up can we go and get 1140. Well, here's the ask. This will be a small debit, and that's got to be a sell. 20-cent net debit. It's actually saying credit. No, I think it's a net debit right now. So I would say a 20-cent net debit. You could even do even. I think I'd work this at even. If you're at zero, that's what is called a zero cost collar. This is a learning opportunity. You'd actually put even in here instead of zero. It's going to reject it if you put zero. If you're trying to execute this trade at no cost, no credit, no debit, even zero, you have to put even in the actual order type here. So let's leave it at even. So if we do this, we have 7 points of upside or of downside. That's our coverage. This is our collar, protecting us from 160 on down. We have the right to put the stock. If we have 100 shares, we could put the stock at 160 to anybody or somebody out there that bought the other side, some put seller. And then on the upside, you have 12.5 points all the way up to 180. So on the upside, you have the 12.5 points all the way up to 180 from 160 to 1. So you got 7.5 points of risk, and you're able to do this for zero. It's another interesting trade. Now, the biggest thing about SpaceX is if it comes back, it can come roaring back, and it makes it very hard when you have this short call, especially if you have a loss on it. If you bought it at 190 and you're selling to 180, then that's a little tougher to give up the stock at 180. But in this instance, this is an interesting trade. If you're nervous in SpaceX, should we stay in? Should we get out? What should we do? This is an interesting alternative. And if the SpaceX continues on down, don't forget that you can buy to close the 180 short call option and sell to close the long put and just remain long the stock. You don't have to use the option contracts to either exercise to sell the stock because it went down or actually take the obligation to sell the stock because it went up. You can actually trade out of the options, but this would allow you to maybe sit in the marketplace right now. And those are the two trades that we won over the last couple of weeks, and SpaceX has been all over the news. So, and you can look at that in Google too. You know, Google's down 7% today. Looking at a double up to catch up strategy in Google would probably work. And once again, you can trade out of them to begin with. But if you have a few hundred shares of Google, that is an interesting alternative and an interesting way to hold your position, I guess. All right. So that's going to be it for this edition of Options Guy TV. Go back, look at the Fundamental Friday. I actually put a whole PowerPoint together Fridays. The market was foreclosed. So I built a PowerPoint on the collar strategy in SpaceX. Feel free to go back and review that if you like, if you are interested in this trade, if you got stuck in SpaceX and now you're not quite sure what to do. We did a couple of trades over the last two sessions. This is an interesting alternative. We're going to come back on Wednesday, see where Micron is at, and look at a skip strike butterfly in Micron. Thanks for stopping in. See you Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.